I sold my shares a day before Labour announced the new taxes. I wouldn't suggest that someone who's still just starting to invest should start with SEIS. I think you should start with ISA, understand the basic principles of investing, understand risk and risk management. Any money you put inside an ISA, as long as you've not crossed the limit, is tax-free. Any money you put through the stock and shares ISA, you can invest it through that stock and shares ISA. So most people say, should I invest in a stock and shares ISA? You can't invest in a stock and shares ISA. You can invest through a stock and shares ISA. Think of bonds like an IOU, like you borrowed money to somebody and now they're paying you some money back. So if you borrow money to the UK government, it's called gilt. GILT. Big problem with bonds: inflation. Inflation usually tends to outpace bonds, but bonds is much more safer than stocks in terms of volatility. Why some people won't buy bonds? They think, well, if I buy S&P 500, it's basically like the volatility is very low. There's a high chance I'm going to be all right. But if you're getting closer to retirement or when you need the money, you want less stories.
So I'm just going to read directly from one of the options that you put on the email.
That's
one of the
correct.
points is how to use ISAs and SEIS to invest tax efficiently in shares, bonds, and startups. So I'm more interested in the bonds and startups anyway.
Fantastic question. Now, if you followed me for a while, you know I'm a big fan of being tax efficient. Sometimes you're trying to hustle and make extra money, but just plugging your taxes. One of the things that people find eye-opening in our one-to-one session is finding the areas where they're leaking thousands of tax. Sometimes it's 10,000, 12,000, 20. So it also applies to investing. So if you're saving your money, now if you've got up to £10,000 in savings here, it could be at risk of a penalty from HMRC, not for saving, but because you might be getting an interest on your savings that is above the savings allowance and you're not declaring it. Let me explain that. If you save money in a bank, you get something called interest if it's in a savings account. Let's just take a figure, let's say 5%. So if you save like 10,000 or let's say 20,000 in your bank account, regular bank account, and you get 5% of it, so you've already gotten £1,000 in interest. HMRC says that is the maximum you can get tax-free if you are a basic rate taxpayer. So if you're a basic rate taxpayer and you're paying just at 20%, that is the maximum you can get tax-free. Now, HMRC says if you then are a basic rate taxpayer, the maximum you can get interest tax-free is £1,000. But if you are fortunate or unfortunate to be earning enough, as you will be soon, to be a higher rate taxpayer, that's about 50k. Now, the maximum you're allowed is £500. So even if you get 10,000 and you have 5% interest, you've hit your maximum. Now, any money above that in interest, you need to declare it in your self-assessment. Whether you do self-assessment or not, you now have to do self-assessment or call HMRC to say, I made this money in interest. Now I've got to pay like a tax on it. So these are the issues. How can you avoid that? You use our tax protector, our tax defender, which you mentioned, ISA. Any money you put inside an ISA, as long as you've not crossed the limit, is tax-free. So if I say to people, you know about emergency fund, well done. Now I'm proud of you. You saved 3 to 6 months of your living expenses before you start investing, because that's one of the absolute things I suggest you do before you start investing, so that you don't have to sell because you need money suddenly.
Earning well used to mean financial security, not anymore. I've read over 250 books on personal finance and business. Not one of them explains specific issues that affect medics like NHS pensions, financial anxiety, investing, student loans, and much more. Hi, I'm Dr. Andy Egwim. I'm the founder of MoneyWiseDoctor.com. For over 21 years, I've been investing and studying personal finance. In fact, 3 years ago, I left my salaried NHS GP job after achieving financial independence. Since then, over 1,200 medics have joined our tax-efficient investing masterclasses that are totally free. And much more than that, 10,000 doctors and healthcare professionals have used my content to make smarter financial decisions and avoid costly mistakes. That's why I wrote the MoneyWise Doctor. The MoneyWise Doctor is a step-by-step guide, it's a book to simplify the path from confusion to clarity for medics and to help you make smarter financial decisions and avoid costly mistakes that can affect your future. We've already helped thousands of doctors learn how to save smarter, invest tax efficiently, and finally feel in control, in charge of their financial future. Now, if you're ready to gain clarity, confidence, and control with your money, tap below to join the wait list for the MoneyWise Doctor book so you can get all the fabulous benefits and the bonuses for the first readers.
But now, don't take that emergency fund and put it in a random savings account. You want to put it in a cash ISA. That way, any interest it yields. Because sometimes some people's emergency fund might be 10K, 20K, depending on your monthly expense, right? So you want to put it in a cash ISA so that that interest is not going to be taxed. There's also stock and shares ISA. The stock and shares ISA, unlike the cash ISA, is just for investing. It's not for saving money. It's for investing. Now, with the stock and shares ISA, one thing you could do is any money you put through the stock and shares ISA, you can invest it through that stock and shares ISA. So most people say, should I invest in a stock and shares ISA? You can't invest in a stock and shares ISA. You can invest through a stock and shares ISA. So you can put money in a stock and shares ISA and then invest it. Now, here's the magic. Any money you put through a stock and shares ISA is totally tax-free. I mean, the returns you get on it. That means if you invested 20,000, even if in 5 years you get 100,000 back, normally you're supposed to pay a percentage of that in taxes, because if you incurred what we call a capital gains. So remember, for those of you who were at the beginning, I said I sold my shares a day before Labour announced the new taxes. I sold my shares that were not in an ISA. Now, an ISA prevents that from happening. Capital gains tax, I think 20 to 24% you have to pay. You can have a look at the exact figure on the increase of your investment. That's the rule. That's the normal thing. I paid capital gains tax in different countries, in Nigeria, in China, if you invest. So, but in the UK, we are blessed with something called stock and shares ISA, which means that you can invest your money, it grows, you don't have to pay any tax on that growth, as long as it was invested through an ISA. Obviously, the government is not going to allow you to invest £1 million. The maximum you can do in an ISA is 20K per year. And that's where some people would invest 20K for yourself, maybe invest 20K for your spouse. If you've got the extra money, obviously, invest 9,000 for your kids, because kids can have 9,000 in junior ISA. Now, that is how to use your stock and shares ISA for investing. You don't pay any interest on the capital gains. This is an opportunity to say that, obviously, ISA, most people think that ISA is just a cash ISA. I think it's 78% of Brits that leave their money in the cash ISA, because either they don't know about stock and shares ISA, they don't know about investing, or they're worried and all that. So that's just one part of it. Now, taking it a bit further, bonds. Now, whether you're buying shares, stock and shares, individual stock and shares like I do, or index funds like Nedu does, who spoke earlier on, or you just want to buy bonds, basically, because these are all investable assets, you can do all of that through your stock and shares ISA. So that will be tax-free. It's not the only instrument you can use to invest. Remember, most investing platforms will start with offering you a general investment account. They'll just say invest. If you click that stuff and you start investing without using your stock and shares ISA, you might be sad even when you make money, because you know that you could have avoided that 20-24% tax. So you want to make sure that you've utilized all your ISA allowance for the year, which is how much in a year? Taxes. Somebody help me. ISA.
This is £20,000.
20,000 pounds. Oh,
Yeah.
great. I wanted to make sure. So I wanted to make sure we're still here. So 20,000. So in the tax year ends in April 5. As sure as the sun rises tomorrow, April 4th, April 5, there's going to be a lot of people ringing me, sending me messages, wanting to book one-on-one, which will be absolutely not available then, because they haven't done what they should do. And a night to tax, so many things can happen that day. You lose out on your allowances. It goes wiped out if you've not used it. If you're 39 and you're about to turn 40, if you've not opened your lifetime ISA, you lose that opportunity forever. If you've not claimed tax relief, I've got a gentleman now, mastermind now. She's not claimed tax relief for 5-6 years, so he's about to claim for the past 5 years. Obviously, you can't claim one now because that tax year has gone. So you want to do something about it between now and March. Don't wait till April 5. So your ISA allowance disappears. after April 5, you get a fresh 20K allowance again. So the same thing when it comes to things like SIP, pension allowance, everything works in tax years, you know. So it's really important to understand that. So for investing, stock and shares ISA, you can use it to buy bonds, you can use it to buy index funds, you can use it to buy individual stocks, you can even use it to buy commodities. That's for stock and shares ISAs. I'm not a huge fan of short trades and commodities. Okay. Now, the other level which you mentioned is SEIS. So SEIS is Seed Enterprise Investment Scheme. So that's the name. But what it basically means is that if I invest in a startup, a company, I think there's a size. The company needs to be less than 3 years old. Maybe capitalization needs to be less than 500K or 250K. If I invest in such a company, the government guarantees 50% of my money. So even if I lose 50% of that money, if I lose that money, the government writes up 50% of it as tax relief. So that's how SEIS works. Obviously, there's EIS as well, which is for bigger companies. But SEIS, I wouldn't suggest that someone who's still just starting to invest should start with SEIS. I think you should start with ISA, understand the basic principles of investing, understand risk and risk management before you then go ahead to, try other things.
To expand a bit, investment savings accounts. If I need to open one, any recommendations or just Google it?
What's investment savings account? Do you mean individual savings account?
Sorry, individual savings account.
ISA.
The random one we got with the bank.
So here's the thing: there are different types of ISAs. It depends on which one you're opening. If you're opening a stock and shares ISA, then one thing you're looking out for is purely fees. Which one charges zero or the least possible fees? Then the second thing is, do they do what you need to do? For instance, if you want to invest in individual stocks, but the platform only does index fund, then it might not be what you need. Now, the other question is not just the fees they charge. There are other fees, like if I decide to close my account, are they going to charge me money for closing my account and moving elsewhere? That's for stock and shares ISA. You can open cash ISA in the same place. Lifetime ISA, basically, not everywhere offers it. I don't recommend anyone in particular. Basically, I could tell you the one I use or the one I would invest money for if I was investing for my 4-year-old or 6-month-old. I think I quite like Invest Engine in terms of their zero fees and also simple to use platform and very, very, very nice interface that makes it easy to manage. But there are many options out there. Okay.
Just very quickly, bonds. I tried to read up bonds on my own, but I felt it was a bit tricky. I know it might be easy to understand for those that know about it, but I've still not got the hang of it yet.
So bonds, basically, think about it this way. I know many people make it sound complex. Think of bonds like an IOU. Like you borrowed money to somebody and now they're paying you some money back. So if you borrow money to the UK government, it's called gilt, GILT. So if you hear bankers saying gilt, they just sound a bit fancy. It's UK government bonds. Now US government bond is called treasuries, and obviously other governments like Nigeria, Russia, Mexico, they also obviously give out some paper or whatever bonds and take your money. If you lend them the money, it's called bonds. Now, what do you get in return? What you get in return is they pay you something called, not a premium now, they give you a coupon. Basically, they might decide to pay you twice a year or once a year an interest. For instance, if the interest rate is 5%, that means that if you lend the government money, they will pay you 5% interest. And you can buy a 10-year treasury bond or 10-year gilt. They will pay you that money for the next 10 years. Let's say you invested 100K in the bonds. You will get like that 5% every year. So that will be how much? 5,000. And at the end of 10 years, they give you back your 100,000. So that's how bonds work. Big problem with bonds, inflation. Inflation usually tends to outpace bonds, but bonds is much more safer than stocks in terms of volatility. I say safer with an inverted comma because safety depends on who owes you the money. If the UK government or US government owes you money, then your chances of getting it back are very high compared to I'm sorry, but I'm just gonna say it again. Venezuelan government. So if government of Venezuela, and even at some point Russia, Mexico, Argentina, they've defaulted on bonds. So they just say, well, we're sorry, we can't pay you. 151 countries have defaulted on bonds in the last 60 years. So any country can default. Some are less likely to default. UK, they pay their bills. US, they pay their bills. Nigeria has never defaulted, but they've come very close many times. When you hear things like structural adjustment program, it means that they were very close to defaulting, and World Bank comes in, or IMF takes over. Let's make things a bit hard for the population, cut subsidies, cut this, so that we can meet our bills and pay our bonds. So that's what happens. But Ghana has defaulted. So relatively bonds, especially sovereign bonds, government bonds, are a bit more safer. I know 7 years ago they tried to sell me Austrian bonds, some investment banker. I thought, like, why would I ever buy Austrian bonds? I was doing better in the stock market. So why some people won't buy bonds? They think, well, if I buy S&P 500, it's basically like the volatility is very low. There's a high chance I'm going to be all right. But if you're getting closer to retirement or when you need the money, you want less stories. Some people start cashing into bonds. Analyzing bonds is a totally different story. It's a different discussion. It's not something we can do in a 1.5 hour session. We're trying to work out bond yield, what we call bond yield. And quite frankly, most people don't need it because you're not a bond trader. If you're just buying some bonds to lower your volatility or to increase the manage the risk profile of your account, you can just take 10% or 20% or 30% of your money, depending on how far you are, to buy the bonds. There's one big thing I want to point out here. Some investment advisors will do something we call 100 minus X rule for bonds. So where they say, okay, let's assume Vin, you're 35 or 40. I know you're much younger than that, but they'll say, well, you're 40. So I'm going to do 100 minus 40. That's your age. So we take like 60% of the money you've got for investment and put it in stocks, and then we'll take 40% and put it in bonds. That's quite a silly thing to do for a doctor or healthcare professional, because at the beginning of your life, you're not earning that much. But as you're going, your income is going up. By the time you're about that 40 or 35, even 35 to 45, your income sort of like gets to the peak. So that's the time you want to be aggressive in investing. Obviously, that's the time I'll be wanting to put more in the stock market to make sure that it's working for me, because I've already missed out the earlier investing parts when I could have been investing a lot, except you've been investing early. So if at 40 years, you're already taking 40% of my money and put it in bonds, they're sitting around there earning 4% per year for the next 20 years. It means I'm going to miss out on a lot of growth that would have come from the stock market. I feel like it's too much high price to pay for safety. So if the person decided, again, not professional advice, because I don't know your current situation, if the person decides to say, well, I'm just going to take like that same amount, I'm going to put it in the stock market, and maybe when I'm 50, 60, I'm going to start cutting down some, putting it in the bonds. And this can be done automatically as well. Some pension funds. We address a lot of these things. I mean, there's a reason why the investment masterclass was 4 weeks. It's not because we like seeing each other every weekend. It was just a lot, and I thought if we tried to teach it in one sitting, it wouldn't work. So we did it for 4 weeks, and then we had follow-up lectures. They were in the group for 12 weeks with me, just a follow-up review. But yeah, I hope that gives you a general idea of bonds. Just one more thing on bonds is that all bonds are not equal. As you know, there are bonds between governments. Government bonds are stronger. There's also corporate bonds. Companies can sell bonds to raise money. And there's junk bonds. People can sell bonds for a big project. You don't know if it will succeed or not. But the higher the risk, the less the return. If the Venezuelan government, I think one day I end up in Venezuela, they're going to stop me and ask me, why do you keep mentioning us as an example? I'm just kidding. But Venezuelan government might be ready to pay you 22%, while the UK government will say, no, we can pay you 4%. So the higher the risk, the higher the chances of return. But remember rule 1 of investing from my, I look up to him quite a bit, Warren Buffett. Rule 1 is don't lose money. And rule 2 is never forget rule 1. So before you dream of the money you're going to make sure you don't want to lose money. And that's why the first class we teach is risk management, asset allocation, risk management. Once you are safe as an investor, then you can do pretty much what you know within your own area of competence. All right.
The financial playbook everyone has been waiting for is coming. The MoneyWise Doctor book. Click on the link to pre-order your copy, plus free bonuses.